2, 1. Hello, everyone. I'm Susan Nash, AAPG, and I'm absolutely delighted to be able to welcome you to the DPA Moneymaker series. I'm going to turn it over right now to Andrea Reynolds, the DPA president, who will tell you all about the webinar series and all the exciting things that DPA has planned. So welcome, Andrea.
Thank you, Susan. Hello, good morning, afternoon, or evening to all participants today. My name is Andrea Reynolds, and I'm currently serving as the president of AAPG's Division of Professional Affairs. I'm excited to welcome you all to the kickoff of DPA's Moneymakers Business of Energy webinar series. This series brings together entrepreneurial geoscientists who have found a way to thrive despite the hardships of our energy industry. The new series provides a unique opportunity to hear the backstories and struggles and learn how these challenges translated into fortitude for building a business, finding capital, keeping ethical resolve, and sometimes reinventing the blueprint to find meaning and success in the world of oil and gas, or forging a new path into new energies. We anticipate these webinars every other month, with our next topic coming up in January. The series will cover all forms of energy, including CCUS, rare minerals mining, and topics at the forefront of our industry. Today, our first DPA Moneymakers Business of Energy webinar naturally begins with petroleum, with two industry veterans, both AAPG past presidents, sharing their stories, experience, and advice on building a successful business. First, we'll hear from Mike Party discussing a tried and true path for funding seismic and land acquisition, essentially laying the groundwork to sell a prospect. And second, we'll hear from Lee Billingsley, who will discuss insights on finding investors, setting deal terms, and presenting your prospect. We plan on 1 hour for the discussions and up to 30 minutes for Q&A at the end. With the webinar, we do have chat, so please put your questions in the chat. We'll be monitoring the questions, and we'll hold the questions until both speakers have concluded their remarks. So please join me and the DPA Executive Committee as we welcome Mike Party and Lee Billingsley. First, let me give a brief introduction on Mike. He, like I said, is an industry veteran with 44 years experience. He is currently the CEO and president of Barrel Oil and Gas and Redbird Exploration based out of Midland, Texas. He started his career at City Service as a geophysicist and has also worked in roles such as exploration manager at Wagner and Brown and VP of exploration for Reliance Energy. He has also served as DPA president and has also been AAPG Southwest Section president. With that, let me hand the floor over to you, Mike.
Thank you, Andrea. I'm going to get this up and working. Let's see. You all should be able to see the screen that says how to build a company. And if I don't hear anybody say they can't, I'll assume it's up and going. What we're going to do is Lee and I are going to kind of tag team you a little bit here this morning. I'm going to kind of go through some of the basics of what's out there, what you're going to be confronted with as you try to navigate through trying to build a company or go out on your own. And we're going to kind of navigate through that. And we'll talk broadly about some of the different issues out there. And then Lee's going to come back in, and it's like we're going to be making an ice cream sundae. We got all the ice cream in there, and Lee's going to come in and put the whipped cream and the cherries and the nuts on top and show you how it all comes together to be what it is and how you get things done. So we're hoping it's going to be a very informative talk for everybody. There's a lot of different ways to do things, and we may not cover every way. I see there's some people on here have been in the industry just as long as Lee and I, and you may know some ways that we don't know, that we don't talk about, but there's a lot of different ways to do it, but we're going to talk about some of them and what you need to know. So let's get kind of started here. Okay, I want to talk briefly because kind of the elephant in the room is private equity, because all that's gone on through the last few years with private equity. Private equity is definitely a way to get money, and it's to get money to do your ideas and buy properties, and especially if you're looking at buying production, which Lee will talk a little bit about. That can come out to be a very good avenue to go. But let me tell you, as geologists, most of you all being geologists on this phone call, unless you have an MBA, a geology degree with an MBA, or unless you have a big background in engineering, private equity is not going to be looking at you to be a CEO of a company, of a group. They tend to want the financial people or the engineers to do that. Now, that's not saying that there's not geologists that are CEOs of private equity companies. There are, but they're not unicorns, but they are white rhinos. They're hard to come by. Private equity looks at the geologist being in the back room with all their picks and everything and trying to find the next place to go. And they don't look at them as being the people that are going to be out there and lead. So if you're looking to do a private equity and control 100% of your destiny, as a geologist, that's going to be difficult. And going private equity is going to be difficult because private equity is going to tell you what you can do and how you have to do it. And they're going to be the ones, if you say, I want to go off and do this in this property, they're going to say, no, you're going to stay focused on this. We don't care that may be the better upside right now, but it's not proven. So private equity can have some pitfalls that way. And like I've had people tell me that sometimes you're making a deal with the devil when you go into private equity. And one of the things, I have looked at a lot of different ways to finance stuff when I was at Reliance. We sat in a lot of meetings with people that are very, very smart people. And we were with a guy that knew more about oil and gas financing in New York one time. And he made the comment with private equity companies, here's the bottom line. Out of 100 companies, 90 of those companies will have an experience they'll never, ever want to have again, and they'll never do private equity ever again. Out of that remaining 10 companies, 5 of them will have a fairly good time, make a little bit of money, and they might do a second run at private equity. And then you got 5 of them left out there. 3 of them are going to do really good, and they're going to like it. And then 2 of them are going to hit the home run. They're going to hit it out of the park. And that's the guys you hear about, the people that went out, had a $300 million private equity commitment and sold the company for billions. You hear about those. You don't hear about the 90 people that had a terrible experience. They basically sat there for 5 years and had a continual root canal. So you don't hear about those, but private equity has its place. It's a very good thing to do if you're willing to put up with it and if you can get into the private equity markets. SPACs and publics. Public obviously is you get your money through your stock, and so you got to go through like an initial public offering. So if you're private, you go public. SPACs is just an avenue to get there, which is special purpose acquisition corps. And basically you take a penny stock, you put money into it through private equity companies, and then you find a property that you want to develop and you put it into the SPAC. And then there you've done your IPO. You're already public. So now you have access to the public markets. But let's say you don't want to do any of this. And that's what I did. When I was with Reliance, we were 100% private, no public private equity money. It was all private money. And when I started Barrel, I looked at private equity interest out there and decided that I didn't want to put up the hassle. And I didn't want somebody telling me what I should be doing, how I should be doing it, and when I should be doing it. And if they're wrong, I go down in flames because of them, not because of me. If I'm going to fail, I want to fail on my grounds, not on somebody else's. So I went the way that, and this is just showing how you can go from basically a private company to a public company. And Colgate did that. They went from a private equity back to an IPO, and now they're merging with Centennial and then the new Permian Resources. So how to make $1 million in the oil business? Everybody wants to know that. Well, it's pretty easy. Just start with $10 million. You start with $10 million, you can get there. So the objective of this talk and what I'm going to do is not try to scare you, but lay out what is ahead of you when you start an exploration company without private equity or public money, where you're going to put some of your own money in there. You're going to take friends and family's money to put in there. You're going to find people that you've known through the years that are willing to risk some money, and you're going to put that money together and come up with ways to get into place without a lot of commitment on dollars, but you'll be able to go in and do it. Lee will talk about some of these. There are ways to do that with minimal exposure, dollar exposure on your end. This is a very good TED Talk. Kiki Ayers does a very good TED Talk on how do we know if you're meant to be an entrepreneur? And she does a really good job at this because like she talks about, if you looked at LinkedIn, everybody talks about being an entrepreneur. Everybody's an entrepreneur because you ask the simple questions. Do you want to be your own boss? Well, who's going to say no to that? Do you want to set your own work schedule? Well, sure, everybody likes that. Do you want to make lots of money? Well, that's the end game for a lot of it, self-satisfaction, but everybody wants to make money. Well, she defines an entrepreneur as the person who organizes and operates a business or businesses, taking on greater than normal financial risk in order to do so. So that's the big thing. As you go out on your own, you're going to be taking on a greater than normal financial risk. Now, that doesn't say that, you may not be putting your dollars in, as Lee will show you ways that we can go in and get acreage without committing dollars and be able to develop that to a point where you can drill it without a whole lot of input in dollars from you. But keep in mind, when you become your own boss, an entrepreneur, start your own company, you no longer have medical benefits with the company you work for. you will no longer get a paycheck. So you're going to be living out of your personal savings. So you're going to have to go in and figure out a way through consulting to make a little cash to bide you over, or even in some cases, maybe take a little part-time job someplace to bide you over. But when you stop working for a company, you lose those benefits. And insurance, I can tell you, is not cheap if you're out there doing it on your own. So you are taking a financial risk when you take that step. So beware that you are going in and risking things, even though you may not be taking money out of your bank account, you are going to be drawn into your savings to survive through the time. Okay, what you really should be asking here, if you want to be an entrepreneur, here's the questions you got to answer. Work 24 hours a day, 7 days a week. Because if you're going to go off and try to make a company, you can't decide that I want to go off 3 weeks on vacation, or I don't want to work this week, or I don't want to do anything. Because you've got to put the hard work into it, the dedication, because all these little lapses where you're not doing anything, you're losing contacts and you're losing the ability to keep this project moving forward. And then the other one, are you willing to take every last dime in your bank account and risk losing it? Here's where you get to the fact that if you're out there for 3 or 4 years and you don't sell a deal, you have no income, so you're living off savings. And as Lee will show you, that the bad part about doing this on your own, having your own company, is you can go in and take cash along the way and get a cash draw out of here. Say, I want to sell you this for $100,000. Okay, you sell a deal for $100,000, you're out of it. Okay, that's what you got is $100,000. Now you got to do the next deal. The way you really get to the big end, to where if it works and you get a big reward, is when you start putting some of your own money into it, taking a working interest somehow, a back end working interest, carried working interest, and things like that. If you just take cash, you're basically selling one deal for money. Now you're going to sell another deal and you're on a treadmill. Whereas if you sell a deal and it becomes the next big play in the Permian or in the Rockies, you're going to take cash and you see none of the reward for that. So how do you go about doing this? Well, you got to build a great foundation. Like with any building, you can't have a weak foundation. So you got to build your foundation. How do you build your foundation to be able to know that you can have a good chance of success if you go out on your own? You need to observe all aspects of the business. And a lot of people go, I don't need to know what engineers do. I don't need to know what a land guy does. I don't need to know all that stuff. I'm just worried about putting my head down, making maps, and generating prospects. If that's you, you're probably not cut out to be an entrepreneur, start your own company, because you have to understand what goes on in the land business. Because if you don't, somebody will fleece you. If you don't understand the engineering side, you'll never understand the risk to your deal, what's going on, because you've got to be able to get the deal drilled, and you got to understand on how getting the leases and dealing with the land guys and stuff. So you need to understand all aspects of the business. So don't just go in the office and ignore the land guys and the engineers. Have a beer with them, talk about what they're doing, or have just a soda with them, talk about what they're doing. Study areas and other basins. This becomes really important because as you study other areas and other basins, you learn things that are going on there that in these areas that may be able to translate into what you're doing in your area. So the way the horizontal stuff started didn't start in the Permian Basin. You know, you look at what happened up in the Bakken, and then they transferred it into areas like the Permian Basin. So you need to know what's going on in other areas, other basins that they're making plays work, and you need to know the geology, because that analog up there in the Powder or in the Eagleford may be what you're looking at and what you're doing. So study areas and know other basins. Network constantly. And this is the one thing that I think that a lot of the people who've been in the business for years understand. But if you're going to go off and start your own company, you need to have a network, because you can have the greatest concept out there geologically. If you don't have the money yourself to fund it, you better find somebody that does. That's a network. So when you go to AAPG events, or you go to your local society events, or any oil and gas related event in your local community, look around, look who's operating, look who's drilling wells, find the companies out there and get to know them that are taking deals. Talk to some of your geology buddies and find out, you know, hey, who's out there that's taking deals in this area, because it's with that network that you'll know who to call. So you call that guy, he may not want to do it, but he knows this guy over here that's interested, or this company, and you go and you look at that. So you want to network, and you want to know the men and women in the industry that are movers and shakers in your area, that would be the people that you need to know to be able to find out who is doing what in what place. So you're going to network constantly. I'll show you an example. In my days at Wagner and Brown, we went in, and I bet I probably sold 25, 30 deals in the time I was at Wagner and Brown. We never showed more than 10 times, and most of our partners were 50% partners. And when I did Beryl, we had the first deal we sold to one person. It's a 20,000 acre block for a horizontal well. The last deal we sold, I called 400 different individuals or companies to get that deal sold. So it's getting harder to do deals with one or two people that you know. So you need to have a big network. And if I wouldn't have that network of about 400 people, I would have probably never got this deal done and be getting ready to get it drilled. So network constantly. Day you start the business, network till the day you quit the business. Okay, you got to have a vision and you got to work hard. Come up with a concept, come up with an idea, an area you want to play, start putting together the maps. That's your vision. Put out the play you've got. Look at the play and understand what you're doing. You may like it a lot, but you should ask yourself right off the top, can I find investors and can I get it drilled? And so if you look at it and you're looking at drilling gas in the granite in the Permian Basin, you're probably going to have a hard time finding people to drill that. But if you're looking at a Sprayberry horizontal someplace, you're going to have an easy time doing it. So have a vision and know that you can execute on that vision, and then work hard. You're going to have to work hard at finding people to help you get the leases, any seismic you might need, and things like that. So the hard work component comes in on top of that. And as this sign shows, hard work and easy money aren't in the same direction. And easy money, if you go down that lane, it's pretty hard. There's not a lot of easy money out there. So it happens every once in a while, but you're going to find more by hard work. Always think the impossible, but try for the possible. I mean, all these plays you look at, a lot of them are not new plays. They've been around. People knew it. People saw the geology, in the last 40 years, all the geology was there. It's just finding the technology. That's where understanding other basins come in. Technology that works in the Rockies can be translated to the Permian. And so all of a sudden, if you're watching a play develop in the Rockies, that technology may be a play you can come to the Permian Basin or to whatever basin, the Gulf Coast, and put that play, that concept, that technology to work for you in that play. Okay, how to get started? You need a prospect, a geological concept to sell. So like I said, you need to come up with something that you can go in and find a deal that you can put together, because if you can't get the land, if you go in, like right now in the Permian Basin, there's about 9 counties. If you came up with a great deal in those 9 counties and say the Strawn, your chances of getting it done are slim to none because you can't get the leases, because all those leases in those 9 counties are pretty well tied up. So you need to have a geological concept that you can execute, get the leases, and get it drilled at that point. So, and then you got to decide what you want from your deal. There's a lot of different ways. You can take an overriding royalty right off, just take an override and walk away from it. And so you'll make some money if the well's drilled and good. Carried work and interest, like we talked about, and Lee will talk about these in more detail. We'll give you some interest on the bigger interest. If it works really well and you find a 20 well field, that carried interest can become very, very valuable. Same way, the back end is just another way to do a carried interest. And then if you need the cash, you can take the cash. And that's the thing you've got to look at personally, is how you can mix and match these. You can take some cash, take some carried interest. You can kind of work it different ways, but just make sure that you're not getting yourself overextended where the first deal you did, you took a carried interest. Because the thing that's bad about carried interest and back ends, you get a carried interest on the first, maybe 1 or 2 wells, but after that, you're paying for it. So let's say you get a well that's good, but not really great. And then your partners decide to drill another one. You got to get in or out. So you elect in, and now you drill a well that costs you $200,000-$300,000 or more. That ends up being basically a dry hole. You're out that money. So you always got to look at that is as you go forward. Don't get so far out of your skis that if one of these deals kind of goes south on you, that you have a problem. And keep in mind, when you start having a carried working interest, this is the thing that really gets friends of mine that got involved with this, is that you may think that well is going to cost you $1 million to drill and complete, but then all of a sudden you get into it and you have a problem. We just drilled a well 2 years ago, sliding sleeves, had 42 of them, and the second one from the top after the second frac blew out and we lost the well. So we had drilled a well, ran pipe, and basically we had no well at that point. So we had to evaluate whether we wanted to drill another well on the prospect or walk away. So there's things can happen engineering wise and mechanically that could cause you a problem. So just be careful what you're doing, that you don't get yourself extended to where the next thing you know is you're way out over your skis and you're in trouble. Okay, and decide what exposure you're willing to take as you get ready to do the leasing and or the seismic. Talk about your exposure to yourself. How much exposure can I take? How much exposure do I want? Because you can go out and buy the leases yourself, which gives you a chance to get more of the profits out of it. If it works, you can do the seismic that way, or you can find somebody else to do it. And like I said, you can go back, you can buy the seismic, you can do a partner, do a land bank where somebody comes in, puts up the money for the land bank for a split of your profits, split of the promote. You can cash out, find a company and say, like you come to me and say, hey, you give me $50,000, here's this prospect and I'll go away. You can do that if that's what you want to do. Keep in mind, you're taking cash, you're not getting any upside if you're right. So now you're ready to drill. You get ready to drill, you still have all this same exposure. You've got the leases, you got the seismic. Now you've got an interest where you go in and do you do the carried interest of the back end or any combination. But again, keep in mind your exposure. It's easy to get these things done along the way. You just got to always keep in mind what happens if things don't go exactly the way they should. So is it time to celebrate? No, because now you got to go in and you get that well drilled. Unless you took the override or took the cash, you got to get it drilled. And sometimes little things happen along the way and they're not discoveries. They're dry holes, or you have some mechanical or disasters along the way. But let's say you make a discovery and you got a nice little discovery, you're going to drill 4 or 5 development wells on it. Well, now it's time to take a shot, pat yourself on the back and repeat. Do it again, because unless you hit the home run deal, you probably didn't make enough on that first deal to retire. If you did, you've done really good. Most likely case, you've done enough to keep you going and get you to where you can take more interest in your deals and have a chance of getting a bigger payday at the end. So as you drill these wells, like I say, the road to success is not straight. There's things called curves, failures, called failures, a loop called confusion, and red lights called enemies. And you got everything involved in here, from landowners to whoever operates the well. When they operate, you're solely dependent on them in operations, and they can be doing something you totally disagree with. And so, they may do something bad and you don't like it. That is why you always want to pick your partners wisely. Don't go out there if you don't have to. Don't take a partner that people have talked about that is not a good operator or is not a good partner. And that can be a problem, because you get with a bad partner, that's almost going to lead you down the road to potentially having a bad deal. And so pick your partners. That's where networking comes in, because if you're talking to people, you can vet out those people pretty quick that you want to avoid all until the last minute. If you have to go to them and have to get it done, that's one thing. That you make that business decision. I'm doing this deal with this guy, and I know this is the problem, or this company, and I know this is the problem, but I'm willing to do that. The road to success and the road to failure are almost exactly the same. And I'll show you an example. Everybody knows about the Santa Rita drilled in West Texas. They offloaded all the equipment right along the train tracks and put it together, and they had to get a well spudded by midnight. The original location was 6 miles away. So they decided, there's a lot of stories that the wagon broke down and all these things happened. The real story that everybody believes is true when you talk to historians is they basically offloaded it there, and the Knapp, who was the guy, Pickerel and Knapp, who were the guys involved with it, they realized that they didn't have enough time to take it to the location, get it set up by midnight on that day, 24 hours, have it set up, and spud the well to save the lease. So they spudded the well right where it was at. That was the Texon, which was the first major discovery in West Texas. So their happenstance worked in their favor. This is a shot of the Yates discovery well. And the good thing about the Yates well was nobody wanted to drill across the river, because drilling across the Pecos River, everybody with any intellectual ability at that time knew that across the Pecos River was a terrible place to drill for oil. And even the ranches over there, the ranchers used to talk about the grass and everything was so bad, the buzzards wouldn't even go across the Pecos River. But yet a company that was a predecessor of Marathon took the chance, drilled a structure over there, and found the largest field in the lower 48. So sometimes, these little happenstance and luck can help out. So like we say, most all roads lead to success when you have a vision, a deal that you can operate on and get done, an executable plan, how you can get your money to get the leases, the seismic, to get it drilled. willingness to work hard. You're going to work hard, and you're going to have to work hard because you're working for you. If you don't, at the end of the day, when you start having money problems because you hadn't sold a deal, that's going to be on you. Perseverance, when you have landowners to give you problems, you just keep going. You're going to have all kinds of roadblocks thrown up in your way as you go. You just got to keep going and persevere through all of it. And sometimes, as I showed you in a couple examples, it takes some luck. So then it's time to celebrate. And with that, I'm going to turn it over to Lee to go to his part. I appreciate the time, and I'll answer some questions when we get done. Lee?
Yep.
Mike, let me just jump in. I wanted to introduce Lee real quick. So thank you,
Okay.
Mike, for the fantastic insights from your vast experience. And just a reminder to everybody to please put your questions in the chat for both Mike and Lee. So Lee Billingsley is our second speaker today. He is another industry veteran with significant experience, and he's currently a partner in a new venture called Long Ridge Resources, LLC. Previously, he's also had tons of experience as an independent, as president and founder of Sandia Oil and Gas, VP of exploration for a small public company called Abraxas Petroleum, president and founder of a PE-backed company, Windridge Oil and Gas. And he's also served as AAPG president. So with that, let me welcome you, Lee.
Thank you, Andrea. Can everyone hear me? Can you hear me, Andrea? Okay, good. Thank you. As you heard, thank you, Michael. He went through the kind of the big picture concept, and I'm going to go through more of the granular details. So this is going to be the day-to-day work of how to make happen what Mike was talking about on a large scale picture. Michael, I hope he didn't scare you. He gave you a realistic view of what it's like to be an independent. But I'll tell you something just from my own experience. I was a young independent when things fell apart in the 80s, and I started as an independent then, and worked up to 1998 as an independent. Then I went to work for a small public company called Abraxas. I worked there for 16 years, but then I got the itch to get back in the world of the independent. So that's where I teamed up with my son Matthew, who's also a geologist, and we formed the Windridge venture, went through a private equity experience, and now we're doing it on our own again, which is a lot more fun. And we're back doing what I did many years ago, but now I'm doing it with Matt, and we'll show you some of the things we've been working on and just how we do it. And so this will hopefully save you some time and give you some ideas of the progression of being an independent geologist. Okay, let's start with the prospect progression then. Mike touched on this. It starts with an idea or a concept, and you have to have something unique. You have to have something that's a little different that people will invest with you. And here's various ways that you can do this. Let's just start subsurface mapping. It could be a little prospect that's just an extension. Maybe the reservoir was touched on by a well and it was very thin and not economic, but you have a concept that the reservoir will thicken in a certain direction. And that would be a subsurface mapping example. It could be new play concepts. I'll show you examples of this coming up. This would be totally a new play that you might come up with by making maps in an area and basically keeping your eyes and ears open. And what I like to call this, this is geologic. So don't forget to use your geologic to come up with these concepts, because that's really what you're selling, is your ability to come up with something that's geological, and then you will then put the money behind that concept. Another aspect would be a geophysical interpretation. That's very important in today's world, because there's so much 3D seismic that's been acquired. You got to get your hands on it and be able to interpret it in many of the prospects or plays. And I'll give you some ideas on how to do that and show you some examples. And finally, Don't leave out the world of the engineer, and I'll show you a little example. We're doing one of these right now. It's a production purchase enhancement type prospect. So there's all kinds of different ideas, but this is where you make your money right here. It's in the starting with the idea or the concept. That's what's going to differentiate you from everyone else. Let's see. This is an example. A good friend of mine is Dick Finley. You may have heard of him. He's my age. I went to school with him. He was an independent for years in Billings, I'll say kind of struggled along one little prospect to the next. This story is best told in the AAPG bulletin by another classmate of Dick and mine, Steve Sonnenberg, in the 2009 AAPG bulletin. And it's the story of the Elm Coulee field discovery. Elm Coulee is a 200 million barrel field that is totally credited to Dick Finley, that he discovered as a little independent geologist, just like you, just like any of us. He's no different. Very humble guy, just living from one deal to the next, kind of like what Mike was talking about. The reason I'm going to show you this story is because this is how it can happen for you. And I'm going to just say Finley used geologic and some luck in this. So the Finley story, the history behind this, he and a engineering partner had some prospects. This is in the Williston Basin in Montana. That he had a prospect in the Nisku, which was probably at about 11,000 feet deep. So he, acquired some leases, not very large area, and they sold the deal to some partners, and they drilled the well down to the Nisku, and that particular zone was not productive. But of course, on the way down, they had mudlogged the well and looked at samples, and they had a really good sample show and mudlog show in the Bakken. And this is not unusual out here. The Bakken frequently gave them shows of oil or gas, but it was always a kind of a lost leader. You could make a little money out of it, but never anything really worthwhile. This is what the log looked like. You can see it's got kind of a hot gamma ray, but look at this, the porosity log. You had probably 10 feet of what looks like pay. It's got high porosity right here, and then you've got relatively high resistivity. It's clearly hydrocarbon productive, and everyone knows this because it was the Bakken, which is sort of a source rock. Now this is in the middle Bakken, so it's not the shales above or below. So Finley said, well, let's complete the well. We'll probably make some money on it. So they ran casing and went to complete it. Another little twist to this story is that most people felt that the Bakken was a source rock and was oil wet. And so you should not use sand or water to frack this. But Finley went to a guy that he actually worked at Halliburton, and they said, can you design a frack for us? And the guy said, sure. He said, I think you ought to do just a regular sand water frack. There's no reason for doing these diesel fracks that people have been doing and not putting any sand in it. This is just a tight reservoir like we do in lots of other places. So Finley said, okay, let's try it. So they did a little sand frack on this vertical well. And, they were making some production, and it was okay. They were making a little money every month. And then, and Finley went about his business, doing other prospects. So then, 3, 4, 5, 6 months later, Dick said his partner came to him and said, hey, this well is just not declining very much. There's something weird about it. It's just, after that sand frack we did, it just keeps hanging in there. And Dick said, really? So he said, let me look at that. So Finley looks at the well and he says, well, this is what the logs look like. Let me map this. Now, this is taken from the publication that Sonnenberg put out, but and you'll see there's the contours. This is the net thickness of this pay zone, and maybe it gets up to, there's 12 feet. It might get up to 20 feet in some places. These are 1 mile sections. So you can see it's about 4 miles or, you know, somewhere between 2, 3, 4 miles wide and 10, 12 miles long. So Finley looks at this and he had some well control. This would be the wells that existing. These were not producing in this zone. They were drilled through it, but Finley made a map. And he said, well, look at this. This thing has got a finite extent to it. This is, you know, where it's thickest and best. He said, you know, I think we could repeat this if this is economic. So he and his partner went and leased each of these wells, like just little areas around each of the wells. It didn't cost them much money. And then they looked for partners to do a reentry. So they actually re-entered dry holes and they completed these wells and they made producers. Now they weren't great, but they were okay. You know, they didn't cost a lot of money and they were producing. But about that time, horizontal drilling started coming around. So they had done this, they had fracked this well in 1996. He made his maps a little later than that. And then they went to a partner, and I happen to know the partner in Dallas. He's a partner of ours in some other wells. They went to him and said, hey, I think I've discovered a big oil field and I need a partner, an operator that can develop this. And this guy looked at it and he called his team together and he said, yeah, you know, I think you're right. And so they formed this venture, and they actually went to Halliburton to figure out how to drill horizontal wells and frack them, because nobody had done that. That was never done in the past. People drilled horizontal wells, but they didn't try to frack them. People obviously fracked vertical wells, but never horizontal. So this is in 2000. And this joint venture, the name of the company was Lyco with Halliburton. They formed a joint venture and they basically developed Elm Coulee Field. That's a 200 million barrel field. And this is what set off the whole Bakken play, because this was actually a legitimate reservoir. This was a stratigraphic trap in the Bakken. The rest of the Williston Basin that took off, that was even less of a quality reservoir, and they just kept putting bigger and bigger fracks on it in order to make the Bakken successful. But in Elm Coulee, these were the beginning of the fracks, but it was really a stratigraphic play discovered by Dick Finley. That's a big example of what an independent geologist can do. And there's lots of other stories. Here's another one. This is in the Permian Basin. It's called the Happy Sprayberry Field. It was a discovery, oh gosh, I think it was in the late 90s. The initial well was drilled to about 9,000 feet. It was plugged and abandoned. Some poor little geologist reviewed the log. This is a year or two later. And he looked at it and said, and this would be an example, this isn't the actual log, but this is an example of it. It had a clean clean gamma ray, had high resistivity, had high porosity. This is greater than 18%, I think, shaded in orange there. It gets up in the high to mid 20% porosity. So clearly very porous. It's an oolitic grainstone. What's not to like about that? That just looks like it's got oil in it, doesn't it? This is the calculation using, this is the SW calculation. You see it shaded green because of the oil saturation. That just looks like bypass pay. So this poor little geologist showed it around to all the knowledgeable operators and they all turned him down. It's like, well, that looks like pay, but there's just no production like that in this area. Finally, he sold it to some goofball in Denver who looked at it and wasn't from, this is in the Permian Basin. So this Denver operator had not worked in the Permian, but the Denver operator looked at it just very objectively and said, you know, that looks like oil pay. I'll take your deal. So he bought the deal from the geologist. They went into this dry hole, ran casing, and then perforated it. And yes, it was oil. It ended up being about a 20 million barrel field in this oolitic grainstone. So that's another example of a geologist that did his work. He used his geologic and wasn't dissuaded by other people, but that's what made him his money, was his concept, his idea. And that's, I can't emphasize that enough. This is the most important part of what you'll do. Everything else I'm going to show you after this is just how you can put your idea into practice and how you can make money from your idea. This is one we're working on right now, where we used geophysical interpretation as our idea. In this case, we teamed up with a geophysicist named Deborah Sakry. She's an independent geophysicist that operates the Paradise software. It's a new type of interpretation, a geophysical interpretation software, and it's, I guess, pretty advanced relative to people that would just look at normal amplitudes and things like that. So using this advanced technique, we were able to identify producing fields in this map, and then we were able to identify prospects that haven't been drilled. So you can see there's 3 prospects I'm circling here that are models for fields that have produced. So this is a deal we're currently working on, that Long Ridge is currently marketing this prospect. But that's how we use, that's our concept, our idea. This is how we're doing something that's different from what other people did. So we're selling this concept. Here's another one, and we're doing this one as well. This is the other end of the spectrum, where we're looking to do a production purchase and then an enhancement of it. In this, I won't say where this is, but this is a horizontal open hole well. It came on, in 08 and declined. And you can see they did something to the well here, and then they came in, and this was a matter of cleaning out the lateral. The lateral was actually obstructed, and then they did a clean out process, used some chemical clean outs that it turned out the well had a bunch of salt blocks and other asphaltenes that had precipitated in the wellbore that was greatly restricting production. And so this well is on production. This is not our well. This is a model well that we're looking at that we want to imitate or mimic. And so our prospect is going to be buying wells that look like this and trying to make them look like this. And we have a model. It's we know what it's going to cost. You just have to, and you also need to increase the pump capacity. You can see the water has gone way up, but so is the oil. So this is an example of what we're doing, an idea that we've put together that we'll be selling. So let's kind of review that. Again, this is number 1. This is like, you have to have this. This is the key. So everything else I'm going to talk about now, and this is where your geologic expertise comes into play. The better you are at this, the more successful you'll be. The rest of this, I'm just going to be telling you how you can take this idea and move it forward as a prospect that you can sell and use. Number 2, seismic data procurement. I'll give you a little some hints and ideas here. Seismic's very expensive, you know that. I'm talking about 3D seismic in this case. I'll give you some concepts and ideas. You can't afford to go out and buy large 3D seismic surveys, but you can. There's different ways you can access it. You can go. I've done this. You can go directly to seismic brokers, people that have seismic data, and in many cases, if you're in an area that is not actively being explored, these seismic brokers have this data in their library, and it's just not selling. They're not doing anything with it. It's just sitting there. If you go to them and make a proposal to them, they will frequently let you work their seismic for either for free or for a small fee, and with an option then that you can, if you come up with a prospect, you will share in the proceeds of the prospect, or you'll pay them their full fee for their use of their seismic. So if they're charging, I don't know, $10,000 a mile, and you come up with a prospect, and you're able to sell it, you can tell them, I'll pay you when this prospect sells. And there's all kinds of deals you can make with a seismic broker if otherwise that seismic's just going to sit there and they're not going to get anything for it. So frequently they'll give you an option to work their data. Another way is to team with a geophysicist. Many independent geophysicists have access to seismic data through one means or another. It might be a company or some other arrangement they have. If you can team up with a geophysicist, they might have seismic data that you can use to prospect on. Another one is mineral owners. Sometimes large mineral owners will have the seismic data, and they're very keen to get their minerals developed. And if they have the seismic data, they will, I'll just say, loan it to you so that you can use it and try to come up with a prospect on their land within a certain time period. So that's another way you could maybe get some seismic data without having to come up with cash at the front. The third, number 3 here, this is lease identification or acquisition. You have to have the land. This is basically a real estate transaction. You have to have a tie or have that land secured. If the lease isn't secured in some manner for you, you'll have less to sell and you're subject to bad actors. For instance, if you come up with an idea, but you don't have the lease is available, it might just be too expensive for you, whatever the reason, you're really just selling the concept. You're up here, you're just selling the idea or concept. And if you're lucky enough to show it to someone that's scrupulous and a good honest person, then that's fine. You can go forward and sell that to them without actually having it secured. But your best bet is to actually have the lease tied up in some way. One of the only idea I have for you here, besides getting a partner and actually buying the lease, is sometimes you can get a lease option is a good low-cost option. And this would apply, let's say if there's a mineral owner, a large mineral owner, you might be able to ask them for, let's say, a 1-year option for no cost to you, with your assurance to them that you'll actively pursue prospects on their land. And in that case, they may grant you an option. And then once you've come up with a prospect and you sell your deal, you'll pay the mineral owner their going rate for the leases. So that's a way you can minimize your upfront cost. So you've seen I've introduced the concept of partnering on a prospect. As I mentioned in these previous ways, there's a geophysicist involved, there could be a landman involved, there could be, Mike talked about this, what he called a land bank. That's someone to partner with you to acquire leases. You don't have the capital, and you need a partner that does have capital. And the question there is, well, how do you share this prospect? And a long time ago, Stu Chuber, a good friend of mine who's just recently passed away, he was a longtime independent. And when I was a young independent, I asked Stu, well, how do I share in this prospect? What's a good formula? And he said, well, the way we used to always do it is the generation or the idea that's about a third of the cost or a third of the effort of a prospect. The next part, the acquisition, that's acquiring leases, farm outs, geophysical data, whatever else needs to happen. That could be capital. That's about a third of the prospect. And the other third is finding the buyers and being able to sell it. That's another third. So that's how he would split it. And that formula works for me. And when I've partnered with people, we usually share, I share in this about 1/3. So a typical way that I would do a prospect, then I'm always up here, I'm always generating. So so I'm going to have at least a third of the prospect. I might find a partner who will pay for the leases. I've done this before. Well, they'll pay for all the leases and acquire the leases at their cost. And then the sales, we do it jointly. If they have some contacts, we'll end up selling it. So in that case, we would share 50-50. And so that they would have all the money tied. And then when we sold the prospect, they would get all their money back. And then we would share the profits half and half. So that's just a good formula for, this would be like an industry partner that would help with the acquisition cost if it's more than you can afford. Another time I've done it where I had a silent partner, that's down below here. And all they did was the acquisition cost. They were, like Mike said, the land bank. So in this case, I told them, since they weren't going to do any of this work, they were not an industry partner. They were strictly, they had invested in other deals with us. So they put up the money for all of the leases. Then we sold the prospect, put the idea together, and they got 25% of the profit. They got all their money back, of course, and then 25% of the profit and 25% of the carry in the well. So that's an example of how you can share. Frequently, I end up with this 50-50 when people end up helping on selling and different things. So we're going through the progression now. Now we're going to get down into the prospect assembly. There you've got to have, Mike talked about this, you've got to know every aspect of the business. And in that would include putting together the drilling completion costs, the land and the title, how it comes together. And then the C, this is the important part now, the prospect offering terms. How do you offer this to buyers? And then finally, of course, you're going to do the economics from the buyer. You're going to show them, how successful they'll be if the prospect is successful. So we're going to look at these prospect offering terms now. Mike hit on some of these earlier, and I'll go through them in great detail. This can be a very confusing part of this process. There's two ways to do a prospect, and Mike mentioned this in his presentation. I'll just separate it as wholesale and retail. In the wholesale case, you sell 100% of your prospect to an operator, and they will usually resell it to investors then. So in this case, you'll make cash from upfront and usually an override. And that can be a very successful way for an independent because it doesn't cost you any money. You get an override in wells that come in, and that's what we call mailbox money. It's something that comes every month. The second way is retail, and that's where you sell to buyers who are investing their own money. There's no room to resell it because you've gotten all the promote out of it. And so that's kind of the two end members of this. So let's look at the pros and cons of that. Wholesale, as we said, receives a cash profit plus an override. The advantage there, you can move on to the next prospect. If you're not good at the business aspects, you don't want to get involved with operations and just your personality, whatever the case. And lots of times this is where somebody was starting out as an independent, this is where you would be. And there's no cost bearing aspect to it because you've got an overriding royalty interest. And I'll assume everyone knows what that is. If not, put it in your questions. The disadvantage, you're going to make less cash and you lose control of your prospects. I've done this before in my early days, and I soon became exasperated with it because the operator couldn't resell my deal to his own partners. So he ended up not drilling it. I ended up getting the prospect back because that was the terms under which I sold it to him. If he didn't drill it within a certain time, he had to reassign it to me, which he did. And then I ended up reselling it on a retail basis and, going forward that way. That's when I got in the retail selling business, was when I couldn't get them, when I lost control of the prospect, basically. So retail, typically you're going to receive it. This is typically going to be a carried working interest. Sometimes you can put a little cash override on it also, but let's just say this is the more typical carry. It's a carried working interest, CWI. In this case, you're going to have to, somebody's going to have to operate this well, and that's usually determined by the buyers. Currently, I don't want to operate that many wells, so I typically show my deals to buyers that are operators. So they might have, they want to buy 25 to 50% of this deal, and they want to operate it, and that's okay with me. If you are selling it to other people that are not operators, then you will have to operate, and that's a whole nother. That's a seminar in itself, an all-day seminar talking about operations. The advantages of doing something retail: you retain a larger interest, you have maintained control over your prospect, and you have operations. The operations can make you some money. There's advantages to having operations. The disadvantages: it's harder to sell because you have to, usually you're selling it in smaller pieces, and you can't just sell it to one person and be done with it. There's less time for other prospects. This is a very consuming way to do it, all consuming. And just like up here, operations also is a disadvantage. So let's look real quick at an outline of a retail drilling deal. So what do you get out of it when you do something retail, now that I've told you that it's possibly a very successful way to do it? This is a typical prospect. This is a vertical well. It's 6,000 feet deep. It's not expensive. It's simple, based on a geologic concept or a geophysical concept, and your idea is sound. It's a good idea. What do we do? Okay, so let's say we've spent $100,000 for the leases, title opinion, and then we're going to put another G&G fee, geological and geophysical fee of, let's say it's $50,000. So that's our trade. Estimated cost: here's the cost, dry hole cost to casing point, $550, completion cost, total well cost right here. We're going to sell this on what's called a third for a quarter to casing point on the initial well. If you say this to any industry investor, they'll ask you, what's your terms? And you say it's a third for a quarter. They know what you mean. And this is what it means. And I'll go through the details of it. Third for a quarter to casing point. And what that means is then your heads up, or you're going to pay your share of completion costs on the initial wells, and you're going to pay your share of development costs. So this, if someone asks you, this is just a good summary, abstract way of, or the summary way of explaining third for a quarter and heads up on completion. What does it look like in detail? So the buyer pays 33 and a third percent of the drilling cost to casing point, or 25% of the working interest in the prospect. So, and when you do this, you also include those upfront costs and the carry. And the upfront costs, as I had in this example, were like $150,000. So that would be like the lease costs, geophysical costs, etc. So the buyer is going to pay then 25% of the completion costs in the initial well if it's successful, and 25% of all the development well costs. So the only well they're actually paying extra on is the initial well. And the seller, that's you're going to pay the same as the buyer in C above. So you're only going to pay your share of completion costs, but you're going to have to pay for the development wells also. That's called heads up, meaning everyone pays their own way. You might be able to get a little profit on the upfront cost in this case, and then but buyers heavily scrutinize how much money you're making on the upfront cost. They don't mind you getting the carried interest in the well, but they don't want you making a lot of money here. Usually, I'll tell you that right now. They very much scrutinize that. So the reason this is so popular with buyers, and it's such an easy way or easy form of selling a deal, is because the bulk of your reward comes in the form of equity in the prospect. The seller, you're aligned with the buyer. If you drill a dry hole, the buyer's unhappy, and so are you. If you drill a successful well, the buyer's happy, and so are you. So this alignment is very critical to a buyer. They want this alignment right here. There's a little bit of terminology confusion, the way people present these deals. This is the way I do it, and it seems to be clear to people that I present to. You're only going to sell 75% working interest in your prospect. That's all that's available for sale, because you're keeping 25%. The seller, that's you, needs 3 buyers at 25% each. So those buyers will each pay a third. So that times 3 equals 100%. So your deal will be sold when you find 3 buyers at 25%. Some people, they don't want to have a full quarter. They can only afford, say, 10%, and you would calculate it this way. So if they had a 10% working interest, it would be 10 times 100 divided by 75 is equal. So 10% working interest in the prospect is going to pay 13% before casing point. Here's an example of it on a table. We're kind of little short on time, but I'll try to go through this quickly. Here's your wildcat well. There's the 150,000 we talked about. There's the drilling cost to casing point. So here's the total cost of the initial well. The investor for a 25% interest is going to pay 231,000. The completion cost to 100% is here. So this same investor is going to pay this amount for the completion. So their total well, the initial well for them is this amount, 368,000. When you go to drill a development well, there's no fee, there's no more land or fees. They're going to pay this cost, and it's just the 25% times that, and the completions here. So this is their development well cost, 275. So quite a bit less. What does it look like to the seller? You're going to have, remember, 25% interest in the prospect. You've got no cost up here in this initial part. Then you're going to have to pay your share of the completion. So the initial well costs you $137,500 to complete it. Seller's profit. Remember, we talked about maybe you'll make some money on the front end. The real profit comes right here. You've made about $175,000 because you're being carried on this $700,000 initial well cost. So about $175,000, but that doesn't come to you as cash. That comes to you as an interest in the well. So that's the alignment where you have to be, the well needs to make money for this to be a successful investment for you. Otherwise, you lose this money too if it's a dry hole. Single well economics. I'll just give you a quick, I always do things as an investor, the investor version. So their initial well, if the well makes 100,000 barrels, they're going to get almost 3 times their money back on that well. But if it's a development well, they're going to get 4 times their money because there's no carry and there's no lease cost. 200,000 barrel well, they're going to get 8 times their money. And in this case, the initial well, they'll only get 5.5 times their money. So this is why the investor doesn't mind being punished on the first well and paying you for your efforts, because then they get to drill development wells and have no lease cost and no carried working interest. And this is where the real money is made when you can develop a field. Remember what Dick Finley did in the Elm Coulee, where he had, I don't know, many wells drilled. And the same with the guy if you had discovered the Happy Sprayberry field, you'd have had, there's 30 or 40 wells drilled. So that's where all the big money comes in, is when you do development drilling. I'm going to wrap up now, just finding investors. Michael touched on it, and this is just absolutely critical, is your professional network. It's funny. I practice what I preached. I talked to Michael, and I practiced our talk last night. I'm selling a deal right now, and I talked to Michael and asked him what if he knew of some people that might be interested in my deal, and he gave me 2 names of people that I had never met before and didn't know. I'm going to be calling them later today. Thank you, Mike. But that's just an example of professional networking. I use it all the time. So does Mike. And AAPG, this is why I stress to young people, you need to be involved with AAPG. These are the best network of people you can find. You can also join sites, very good network also. When you're looking for investors, you can look for operators. If you're looking to sell a deal like I was showing here, just look for operators in the area. They're always happy to look at new prospects because they want to drill more wells. You can also find non-op working interest owners. I haven't done too much of this. You can usually get these people from referrals from other people, but you can also go and look in the county records and see who is participating in other people's wells. It's a public record, so you can find other working interest owners in the records in a county. that you could, get the names of companies and then call on them. And many of these people, they invest in wells, and then when the wells are successful, they're successful investors. But they want to reinvest that money, and that's their job. They need to keep turning that money over, because once they get money from a well, they want to put it back into new wells, because wells, as you know, deplete. So they're always looking for places to reinvest their money. So that's a great source of people to buy your deal. So with that, I think I'll wrap up, and I think we're open to the questions now, Andrea.
Yeah, thank you, Lee, for the very practical advice and examples from prospect to deal terms, and also how you and Mike worked this together to really be one complete presentation between both speakers. At the beginning of this, I did mention we had 1 hour really for the discussion, and that we will stay on for Q&A. I do know there's a couple comments and questions that Susan will help us through here as we go before I close the meeting. So we'll go to Q&A. If anyone has to drop off, this is being recorded, so you can come back and listen to the Q&A as well. So Susan, over to you.
Okay, great. And I just wanted to mention too that Andrea has been an amazing leader. She mentioned the webinar series. We also have something that started last year as an initiative that's really kicking off is orphan wells. So that's a different kind of opportunity, but just want to make you aware of that. So you'll be getting more information about those. So first of all, Jim Tucker pointed out that inherent in the word entrepreneur is risk, which differentiates your ventures from other time and financial investments. Very true. And I think Dahl Winters had a question about the Paradise software that was then answered by Seva. So I don't know if we need to get into that, but Sarah asked about numbers for overrides. What's a good percentage to ask?
Yeah, and I kind of answered back a little bit on that, Lee, when she asked.
Yeah.
One thing to keep in mind is a lot of leases, like in the Permian, are 75%. It's hard to add an override on to 75% because very few, if any, operators will take on a lease less than 75. But if you happen to get some leases like in the Permian are 87.5%, you could pull a 5% override out of them. And so it's going to depend on what your NRI, your net revenue interest, your lease is, about how much you can get. But typically about 1 to 3%. And like Lee pointed out, is when you start talking about taking overrides and you're talking about getting an operator to operate it, they don't take kindly to you pulling a lot of override out, because it's like you want to make the money, but you don't want to take the risk. So how much do you believe in your deal? And so I see a lot of times if you start trying to take a very big override, you'll get a lot of pushback, even in cases where you have really good NRIs. And so typically you're looking, what I've seen, 1 to 3. I know people have gotten 5, 6%, depending on their leases, but that's kind of what we see in the Permian. Lee?
Yeah, no, I agree. It's what I used to do is I had a company called Sandia Oil and Gas, and what I would do is if we could get a high net revenue lease, we would put 1, 2, or 3% of an override, and literally it got shared by several of us as individuals, including myself. But it'd be like maybe a landman, the generating geologist, and myself. We would each take maybe 1% if we could get 3%. So so when I would sell the deal, I would just say, look, we're not making much money up front. This is how we're compensating the people, the individuals in the prospect. And that's why we're able to, keep the doors open, because we don't pay a lot of money to each other. And we're getting it in the form of an override. And usually that would slide by. But as Mike said, there is a lot of pushback on overrides. Now, if you don't have the working interest and you just have an override, that's your only compensation. Yeah, I would say, maybe 3% if you could do it. We've taken some leases in the Permian. These are not in hot areas, but you can get a 20% royalty lease from the landowner, and then you might be able to put 2 or 3% as an override on that. So that's kind of give you an idea.
Okay, great. So Seva has a question that kind of segues onto that, and then Andrea's question would be a more general one. Seva says, two problems I have encountered. A group organizer collected money, had a management fee, and was not too much concerned with well results. And then second, even though there was a good zone to complete the well, the operator did not want to do that. And with the 10% working interest our group had, there was no impact on the operator.
Well, I think Lee answered that question earlier, is that you want to make sure whoever you're involved with is the operator, you and the operator are aligned with what you plan to do. And I can tell you in the deals that I operate, and we operate a lot of deals, we're aligned 100% with our investors. We don't have anything, there's no reason for us to sit there and hold a deal, because if there's a good zone, we've got to get it done, because like Lee points out, if the operator and everybody's aligned, everybody's got their money invested, and just leaving it sit there and trying to get a management fee out of it and pay your overhead is not what you're trying to do. And if you've got an operator that's doing that, I would suggest you find somebody else to invest with, because your goals aren't aligned as an investor and an operator. And there's a lot of people out there, like I say, that's why we have a good time with our partners, is we're so aligned. We'll have money into it and we'll be putting things into it. And we only succeed when the project succeeds. And the minute we start losing money on the project, even with the fees involved, we still lose money and we're ready to get out of it.
I'll make a little comment. I haven't experienced this firsthand, but I know Michael will be able to confirm this. There are operators that will sell more than the interest available, if you've ever heard of that before. So imagine someone selling, instead of, they might sell 150% of the deal. So imagine what happens there. They don't want it to be successful, because people will find out that they've oversold the deal and they basically made money on the upfront. So it has to be a dry hole. That I've never been experienced with that. I've just heard those stories. So if you've got somebody, if there's an operator that's charging large management fees and not completing wells that look to be successful, there might be some other things going on. So it depends on, you got to be with a really good operator. That's got to be trustworthy.
That ties in with Andrea's question. A question for both Mike and Lee. Are there specific pitfalls or red flags to look out for, especially as a new entrepreneur? Do you have any examples of deals that didn't work out as you had anticipated?
You want to go first on that one, Lee?
Oh gosh, yeah. Let's see. Well, I've been pretty fortunate. I don't know, the deal I told you about, what I got into eventually selling a deal on a retail basis was I sold a deal, got cash and override. I purchased the leases myself, sold it to an operator. Then they took a year and couldn't sell the deal to their investors. So maybe product prices dropped. I don't remember what exactly happened, but under the terms of my sale to them, they had to reassign it to me. So they reassigned it, and then I sold it on what I would call a retail basis. But then that's when I became an operator, was because I had control of my own prospect. So it wasn't horrible. Nothing went wrong there. Let's see. I guess another maybe a little pitfall that happened to me recently. When you're out showing a deal, you're like the way I do it, and Mike does it too. He's selling his deals retail, just like I am. And when you sell your deal, you're showing your deal to somebody, and somebody will verbally say, okay, we'll take it. We'll take 10% or 15 or 20 or whatever they say. We'll take it. And I say, okay, I mark you down. I send them an email. This is what you've committed to do, and this is what it's going to cost. We don't send them any paperwork. We don't ask them to pay anything until it's all sold, and then everyone pays at the same time. Sometimes you end up with a lag. The first person that buys it, it might be 2, 3, 4 months before you sell the rest of the deal. So that's always a nerve-wracking time, trying to make sure your initial people they're verbally committed, but there's nothing in writing yet in terms of them putting money in, signing agreements. So I had a deal where somebody said they would take it, and it was actually the operator. It was the last piece of the deal. So I had to call people and say, well, this deal's gone now. It's sold. And then we messed around with this operator for a month, and they kept trying to change the terms of the deal. And that was my worst experience, when this operator kept retrading us. And anyway, finally we got it odds and just said, okay, you're out. And they said, we're out. We want to be out. So fortunately we parted ways. Now I'm back selling the deal again, but that was a bad experience. I don't know how to get away from that other than be more careful with who you show the deal to, but who knew that was going to happen. So that's a pitfall.
Well,
Go
and I
ahead,
would
Mike,
say,
I'm sure you've got some.
I would say to what you're talking about there, we don't give them a chance to do that. They sign a commitment letter. Guy says he wants to take part of our deal. We send them a commitment letter, says they're signed up, committed to that percentage of that deal at these promotes. And they're signed up, and we have them signed up in a folder, committed before we go forward. Because you will have people do that. They'll come up and like I always tell people, everybody loves your deal till they turn it down. And they'll tell you how great that deal is, and they want to do it. And I've talked to my boss, and I've talked to this guy, and everybody wants to do this deal. And then the next thing you know, you'll get a call from them. It just doesn't fit our pistol. And so, the deal's never sold till they're signed on the dotted line, and we make them sign. Another pitfall that's out there is how much exposure to your deal do you want people to have out there in terms of knowing what you're doing? We make everybody that we don't have some form of trust with, if it's the first time we've done business, they sign a non-disclosure confidentiality agreement. Everything we show them, they cannot do. And if they go buy a lease in the AMI area, the area of mutual interest, that they have to turn around and turn that lease to us. They can't do that, because you will have people that will come in, and you'll walk in and you'll show them a deal, and they'll love it to death and everything. And then you'll get it all put together, and you'll go out and start to buy your leases, and you'll find out they're buying leases in there also. So we do everything in this day and time. We do everything with documents. We make them sign, if we don't have done business with them, they sign a confidentiality agreement that everything we're showing them that's not in the public domain is confidential, and there's consequences if they do it. If they don't want to sign it, we don't show it to them, because most reputable companies will not have a hard time signing a CA unless that CA covers all of Ward County. If you got a 5-section prospect and it's centered on an area, they shouldn't have a problem signing. And then the minute they commit, we make them sign a commitment letter. And so once they sign that commitment letter, they're there. Now, one of the things that I've done, Lee, is because I've had people try to do the same thing that you're talking about. And we basically say, look, we'll pull it off the market for a week to get this worked out. After a week, we're selling it again. So if you want to get it worked out, we've got a week to work it out. If not, we're going to put it back on the market. And that will get them moving, because they don't have an endless time to do it where they feel like they can keep dragging it out because you're not selling it. So we really, it's a sad thing to say when business was done so much on a handshake in the past, but nowadays you've got to have pieces of paper to cover yourself, or you're going to end up, that's going to end up where you're going to get hurt. You're going to have a great idea, and you're going to see it drilled and the field discovered, and somebody else is going to have it.
Yeah, we do the confidentiality also. We didn't talk about that in the seminar, but that's absolutely necessary.
One other thing too, I want to bring up that I thought about when Lee was going through his deal. He was talking about these back ends and carriage. His example shows a carry to the casing point. You can do a carry to any point. All the deals we do is a carry to the tanks. So they're carrying us for an interest till the first oil is produced and sold. So you can do that too. Now, when you do that, you cut out that completion cost side. And so you cut out a little bit of your risk. But typically, a lot of times in those deals, you have to bring something else to the table, like the leases or something, because they're not going to go out and pay for 100% for the leases and then carry you to the tanks in most deals. But there's ways you can get around it and do a little bit of sunk costs, and because leases are defined, you know what you paid for the leases and stuff like that. When you're completing a well, you don't know what's out there. So you can do a carry to any point. So don't just stop at casing point. You can see how you can work it to your advantage.
The difference, I guess, in what you're doing though, Mike, when you drill a horizontal well, it's automatically going to be completed.
That's correct.
So in our case, in our case, we're drilling a vertical well and we're going to log it, and then we have to make a decision. And it could be plugged right there. If we don't see if the zone was not what we thought it was going to be, the well could be plugged, and then it's a dry hole. So
Yeah.
that's the difference in the different type of prospects.
Yeah, and we have several more, several questions. It'd be great to get through them all. So maybe quick little rapid fire answers. Some of them are already kind of covered, but Brett Sullivan asks, what is a good goal as to how often a prospect generator should churn out a prospect?
That's a good one. My goal was one per year.
And that's drill ready with the leases?
Yeah, and actually getting it sold. And as I like to describe it, we're like anacondas. We eat once a year.
And I think that's a good realistic goal. If you can do more than one a year, that's great. But it takes a lot of time and effort unless you're just spending them out and shipping them off to somebody to get it all done. So one is probably a good place to look at.
That makes sense, especially with getting the seismic plus the leases tied up, nailed down. Okay, so what role does petrophysics play in identifying new or bypassed pay?
That's the most critical role there. If you're looking for bypass pay, that was the role of the Happy Sprayberry example. That was just, and that wasn't, I wouldn't say detailed petrophysics. That's as we used to say, the paper boy could find this one. That was the paper boy prospect would be like the guy delivering your papers could read that log and say that was successful. But in other cases, there's more subtle opportunities. In the case of Dick Finley's discovery, that was also just pretty basic log analysis. He just mapped the basic thickness of that, what he thought was pay, and then it turned out to be a big field. So
yeah. And I think what you got to look at, depending on your deal, petrophysics has got to be something you put in there. I mean, it's like trying to sell a car. You want to take the best attribute of that car and highlight it to your buyer. So if you've got some petrophysics you can do to show that this zone is a bypass pay, and you compare it to other wells around, or this zone is the same zone, they're going horizontal in 2 counties away, and you can compare the petrophysics to it. That is what you've got to do. Find out what makes your prospect irresistible to somebody. And whether it's a petrophysics, whether it's seismic attributes or whatever it is, you need to find and latch onto that, because it's going to help you sell it. And if you're talking about log calculations and all you've done is just done a couple of hand calculations, said, well, look, you do the humble equation, this calculates out to be 30% water saturation. Typically, when we get involved, even in vertical plays, we'll take and pull logs that around and compare logs, even in the horizontal place, just compare half a dozen logs that are good, bad, and indifferent to how they map. So always look at those attributes, petrophysics, seismic, and everything. How can that help you sell your deal? Because that's the idea. Get it done quick. The quicker you get it done, get it drilled, the better off you are. And if doing a petrophysics analysis does that, and people are going to ask if you're talking about petrophysics, you're talking about a zone having good porosity, good resistivities, and it looks productive, they're going to want to see the petrophysics.
Okay, so Thomas Prent, great answers. Thomas Prent has, in your experience, to what degree does volatility in interest rates and commodity prices affect the ability to negotiate a carried working interest versus a back-end after payout working interest?
I would say commodity prices are the important thing. Interest rates, not so much. Most of the people that we sell to, and I imagine Mike would say the same, are reinvesting cash flow. They're not borrowing money to invest in these projects. So interest rates not as important, but the commodity prices certainly are. And right now we seem that there's kind of a semi-stable outlook where I model things at $80 a barrel, and that works with a lot of lot of projects.
Yeah, and kind of unintended consequence of commodity prices. We've had a really good commodity price this year. So a lot of these small investors are flush with cash that they're going to have to pay taxes on. And so we have a lot of them. We're actually going to drill a well the first quarter of next year. And a lot of our partners want to pre-bill so they can use the tax dollars for this year. So there's things like that to go on. So commodity prices, like Lee said, it's easier to sell a deal when prices are going up than when they're going down. If people think we're headed for $120 oil, they're more fired up to buy a deal than if they think we're headed for $50 oil. And then things like taxes and stuff. With small investors, taxes become an issue of what the year they're going to pay their taxes in. Thomas also asked about a carried working interest versus a back-end interest. They're kind of the same thing. It's just, you get a carried interest from the start. You'll have a carried interest and they're going to all come out the same. Back-end interest is after payout. So if you can do that payout on a project payout. And if it's a project payout, you may wait 5 years to see that back end kick in. So that's where you got to worry about your back end working interest. What part does it back in? Does it back in after the first well, second well, or after the project? And so you got to worry about that. But they're all a carried interest where you don't put any interest in there. And typically a carried interest will be relegated to the first well, and you might get a carried interest in the first couple of wells. There's times when people get more than that, but the back end working interest, you got to be careful when that back end occurs.
Mm-hmm. You got to trust your operator.
Yeah. That's it.
Anyway, okay, so what about, Stan Lindsay asks, what about private investors? Do you get them to sign a qualified investor form so that you're not acting as a broker?
Do you deal with that, Lee?
No.
I can tell you what we do is the qualified investor, as long as you're going out, the way the law states that we have been told by a lawyer is the way the law states that if you're selling to someone that's actively involved in oil and gas, doesn't apply. They're considered to be a knowledgeable person in the industry. Now, if you go out and you're going to go to your local church and sell it to people that work in a factory that have no clue of the oil and gas industry, you better watch out. So if you're selling to people that have oil and gas revenue, oil and gas wells, you're not in the problem with it because they are considered to be knowledgeable investors and you don't have to worry about it. But if you're going to go out and start going across state lines and trying to go into a place and walk into a restaurant and sell to people that you just meet for the first time that have no business, that have never done anything in the oil industry, you drill a dry hole, you might get sued.
You might get this SEC after you too.
Yes, exactly.
No.
Anyway, Lee, did you have a comment?
No, I don't deal with the qualified investor, just like Mike said. And I think there also has to do with the number of investors in your deal. I can't remember if it's 30 or something. If you have more than 30, you have to worry about that. If it's less than that, you don't. That's just one less thing I don't deal with.
Several years ago, a couple of people tried sort of like crowdsourcing for wells, and I don't think they went. I don't see any here today, so I don't think it went well.
Yeah, that's not what I would do. Yeah.
I think if you did that, you might get sued.
Yeah.
So anyway, well, I guess we have, if we can do nanosecond lightning round, what are general terms? What are general terms in carried to the tank versus casing point? Carried to casing point. I think you kind of addressed that one earlier.
Yeah, I think he's going to say that like the casing point is typically a 25% carried interest. I don't, to the tank might be a little less. I'm not sure.
We do actually the same thing, 25% usually, third, fourth quarter carried to the tanks. But I will say when you do the carry to the tanks, again, like Lee pointed out, you're usually talking about a horizontal well or a well where you're really not going to have a casing point election. That's the big difference because you could actually have a well, you could drill a vertical well and not really have a casing point election or like reentry where your reentry is going to be all the way through. But the casing point versus carried to the tanks, like in a lot of the horizontal wells, you're not going to make an election point there anyhow. And so you're going to keep going. And usually to get it carried to the tanks, you're going to put, like in our case, a lot of times we have the lease money tied up in it already. We don't promote the leases. We don't take a prospect fee. That's one of the things we didn't talk about. You can take a prospect fee out of these things. We don't take a prospect fee. We put everything on the backside, so we have a bigger share of the upside.
Okay.
Great. So we have, we're pretty much out of time, although we do have a couple brief questions. I don't know if we have time, but Andrea, I'll turn it over to you.
Sure. Thank you, Susan. So I just have 2 comments before closing our meeting today. First, a huge hearty thank you to both Mike and Lee for sharing their vast experience with us today. I learned a ton. I know it's hard to take 4 decades worth of experience and insights and share that and condense it, but today was really, really helpful, useful, timely, hopefully for some of the folks on the call today. I'd also like to thank you, Susan, for joining as moderator, and Diane Keim from AAPG staff. My theme this year for DPA is Renew and Engage, and I can't think of a better way to kick off our Moneymakers Business of Energy webinar series than having both Mike and Lee today give us these great insights. The series is really here to talk about the backstories and learning about building a business, some of the pitfalls, some of the successes, and in how that's all worked throughout business. And that's in line with everything that we do in the Division of Professional Affairs. And that's throughout the oil patch and all energy sources. So the last thing I'll say is I really want to welcome the feedback from the participants and anybody watching this playback recording about today's webinar. I invite your thoughts and views on any other topics that you'd like to see in this series, in this forum. We're planning to do this every other month. So our next will be in January, followed by March, and then May. Perhaps you have a Moneymakers story in oil and gas, or even in renewables, CCUS, or maybe know a colleague that does. And I'd love to hear from you and get your feedback. You can reach me at dpapresident@aapg.org. And I think that's all. And thank you all for being here today. I'll now close our session.
Thank you, everyone. And you'll be getting an email with a link to the recording. Thank you.
Thanks, everybody.
Thank you. Enjoyed it.
Thank you.